Podcast Spainsif, plataforma de referencia de la inversión sostenible en España.
Welcome to Podcast Spainsif, an open space for dialoguing about sustainable and responsible investment, where it will be possible to be updated on the novelties, innovation and trends on sustainable finance in Spain. For this occasion, together with Jean-Maurice Ladure, who is heading Index Solution Research for Europe, Middle East and Africa at MSCI, we will be looking into the current status of integrating sustainability in the investment process and the main trends that we are seeing in the market worldwide, given this coronavirus recent outbreak. So there are definitely several reasons that justify the adoption of sustainability criteria, but at the moment, what do you think are the main drivers of this growing interest?
So first, I think I would completely agree with you on this really strong trend we're seeing. We see three main approaches to sustainability. The first one is around values and preferences, aligning a portfolio with investors' ethical values. It's mainly based on exclusion. The second one is impact, aiming to generate measurable social and environmental benefits, as well as financial returns. And the third one is around integration, which incorporate ESG criteria to enhance long-term returns and manage ESG financial risk. So just like you have fundamental criteria like PE or return equity, you also now have those ESG criteria and you want to integrate them. Over the last 3 to 4 years, we've seen very strong trends on all three approaches, in particular, the third one, the integration one. And definitely over the last 18 months, we have seen even more of an acceleration. This is across the globe, led by Europe, but the rest of the world is catching up. In terms of client segment, it is led by the asset owners, but again, the rest of the industry is following, in particular, wealth. Now, in terms of why we've seen this increase in adoption, I think there's really several elements for this. We've seen for a while now more commitment from companies, signatories of UNPRI. Now we are in the implementation phase. It's not about signature anymore, but really putting this into practice. Investors are clearly less tolerant to corporate ESG incident when something bad happened, like the emission scandal with Volkswagen. The price movements are very significant. We see improvement in ESG data and readings, which help you to measure better what previously was more difficult to measure. And also a greater understanding of the financial materiality of ESG. We've passed now the kind of tree hugging intention. We see now that there is a significant materiality impact of ESG. With all this in place, we can see really the willingness to act in terms of investors. And for the one who are a bit undecided, you can see the impact from regulators and policymakers to push this agenda.
This is very interesting. You just mentioned financial materiality on ESG. Could you please detail what you mean by that and how it is integrated at MSCI?
Of course, I won't go into the detail of our ESG ratings. We will need definitely a longer session and will not give justice for the 200 plus analysts at MSCI. We'll just focus on ESG. But there are three key guiding principle. First, we are looking only at the most relevant ESG issues, the ones that can really impact company financially. Second, we are focusing on a risk exposure. We don't just look at disclosure. It's good that some of the policies and guidelines are in place, but really understanding what are the risks the specific companies are exposed to in terms of ESG. And the third element, which is linked to the first two, is we have a best-in-class approach at the sector level. because different sectors will be faced with different key ESG issues. Water stress, for example, won't be an issue for a bank, but can be an issue for a mining company, for example. Based on those ratings, we have published significant research, which is available on our website. We've got foundation paper on ESG, trying to answer a question about can ESG add alpha and how do market price ESG. I won't go into details on this, but the main conclusion is the following. There is a clear transmission channel between ESG and more traditional fundamental financial criteria, such as profitability, systematic risk, and stock-specific risk. We have also identified that good ESG companies tend to have lower cost of capital, both at the equity and at the debt level. Finally, we've identified that equity markets tend to price ESG re-rating or de-rating usually over the next 6 to 9 months. So it's definitely financially material. Now, to integrate ESG, at least at the index level, we have different options. We can have a tilted approach where you got more or less all the stocks of your parent universe, but you just get rid of the worst offenders and then you tilt. The good ESG stocks will be overweight. The one which have good ESG rating or good trend will be overweighted, and the bad one will be underweighted. We have a second option, which is best in class, where for each sector, we will take the top 50% or top 25%. And finally, we have an optimized approach. The idea is really to suit specific client needs and constraints, and it's particularly relevant for ESG.
And speaking about those benchmarks, could you please comment on how they have behaved during this coronavirus crisis?
Absolutely. I mean, the COVID-19 outbreak is the first real live test of the resilience of companies with high ESG ratings. Last time we had such a crisis back in 2008, ESG investing was still in its infancy. So very useful to see how it behaves this time. According to our indices, ESG integration strategy will have been quite resilient during the recent crisis. We can see this across the different options that I've mentioned before, tilted, best in class, and optimized. But we can also see this very consistent across geographies, developed market, emerging market, US, Europe, you name it. If I just take one example, looking at what we call MSCI ACWI ESG leader. ACWI means developed and emerging market. ESG leader means the top 50% for each sector in terms of ESG. The parent index, the traditional index for ACWI, will have lost 21.3% over the first quarter. The ACWI ESG leader index, so the one incorporating ESG, will have only declined by 19.9%. So it's 1.4% better off. Just to put this into context, those two indices are quite close to each other. They have a tracking around 1.2%. So this outperformance is actually significant statistically. Now, based on our research, this is what we would have expected in a way with ESG company, which tend to have better quality and lower risk. In other words, companies that can be slightly more defensive. But it is nice to see that actual confirmation of this resilience. Finally, we can also analyze the relative outperformance across different factors. We've got this risk model, the MSCI bar risk model, which allows to decompose this performance into countries, industry, and style. And it's nice to see that actually a large part of this outperformance can be directly attributed to the ESG rating of a stock, i.e., good ESG stocks have received a relative premium, and on the other end of the ESG spectrum, low ESG companies have been penalized. Interestingly, several other key factors contributed to this outperformance: profitability, low beta, and low stock-specific risk were rewarded, and on the other side, low or high leverage, so company with high leverage, were penalized. So basically, you have quality and low risk, two defensive factors that usually do quite well in period of crisis, which have also been supporting in this context.
Well, this is really good to hear about resilience of sustainable investment with respect to traditional. Just last but not least, Jean-Marie, there is a second very large trend that we have seen over the past few years around decarbonization and climate change. What do you see that's happening at the moment with that?
Yes, we recently launched climate change indices designed to capture the carbon transition risk and opportunities. We even launched some provisional indices in anticipation of the official requirement from the European Commission around decarbonization. You may have heard about the Paris-aligned benchmark. And again, as you say, they have been quite resilient in the first quarter of this year during the crisis. Actually, putting a step back, they have been doing quite well based on the back test we've run over the last 6 or 7 years. So I think we're capturing also a long-term trend with reallocation of capital from brown to green revenue companies. But it is true that we have seen quite an acceleration in terms of outperformance over Q1. Again, we did a performance attribution analysis, and this time it is coming from ESG or factors. It's coming less from ESG or factors, it's coming more from industries. Structurally, the climate change indices tend to be underweight energy stocks, some of the stocks being at risk of asset stranding or product transition risk. And on the other hand, those indices tend to be overweight in tech stock, the one which can offer a solution in terms of global economy, maybe it's efficient energy usage, etc., etc. So clearly that is helping. And admittedly, part of this outperformance can be related to the recent weakness in the oil price due to less demand and also the recent oil price war. But I really believe that the underlying trend will be this reallocation of capital from brown to green.
Well, thank you so much, Jean-Marie, for participating in this podcast, Spainsif, and sharing with us all of this relevant information on sustainable investment, materiality, and sustainable benchmarking in times of pandemic, and in particular, the considerations on climate change and how sustainability can shed some light playing a part on the solution to this crisis. Thank you.
Podcast Spainsif, plataforma de referencia de la inversión sostenible en España.